Again, welcome everyone. Thank you for joining in. We're excited to have Nate Ginsberg. He's the CEO of Centurica. And I would like him to take on introducing himself briefly. So, Nate, take it away.
All right, I am going to share my screen. Okay, can you all see that? All right. Okay, this looks all right. So we can all see. All right, cool. So, yeah, hey everyone. Again, my name is Nate Ginsberg. I'm the CEO of Centurica. And today, I want to talk to you about something that can save you hundreds of thousands of dollars and potentially some very big headaches on your next acquisition. And that is about quality of earnings reports and why every serious acquisition deserves one. And before we dive in, I want to ask if you would ever consider buying a house without an inspection. And I hope the answer is, of course, you wouldn't. And yet still there are many acquisition entrepreneurs and business buyers that are willing to invest 6, even 7 figures in an acquisition based on financials that may be incomplete, inaccurate, or misleading. And so that is where quality of earnings reports come in, and that's what we're going to talk about today. And also, yeah, just before we dive in, there will be a section for questions at the end. And so, yeah, if things come up, feel free to put them in the chat or whatever, and then we'll address them and have time for Q&A at the end. All right, so first I'll share real quick a little bit about myself. Again, I'm Nate Ginsberg, CEO of Centurica. And what makes my perspective a little bit unique is I not only own a quality of earnings company, but I've also completed my own SBA acquisition, so been on your side of the table as well. So I acquired Centurica a little more than 3 years ago through an SBA finance deal, which means that I understand firsthand the anxiety, excitement, and all the critical importance of getting the numbers right when you're putting your own money and future on the line. So since taking over Centurica, we've completed hundreds of quality of earnings reports, totaling hundreds of millions of dollars on deals ranging from, on the low end, about 500K all the way up to 50 million and more. I think our biggest deal we've done is like $83 million. But our sweet spot is really that, small to mid-market space, say like $1 to $10 million, where many buyers are doing their first or second acquisitions. Our focus areas are, we do a ton of service businesses, SMB, HVAC related companies. We also do less now, but still do some e-commerce, SaaS, agency. And yeah, we kind of, when I acquired the company 3 years ago, Centurica was very focused on digital businesses, but then fast forward and the company has evolved, and now we're probably like 80% SMB and then only 20% online, but still have good experience with all the above. So what exactly is quality of earnings? At its core, quality of earnings is a in-depth financial audit specifically designed to verify the true earnings of a business that you are looking to acquire. So you can think of it that QOE is focused on normalized EBITDA and cash flow health. So we're not looking at what the business made last year. We're looking at what it is likely to make going forward under normal operating conditions. So here's what makes QOE different from just looking at tax returns or standard P&L statements. Really, the key is that we rebuild the financials from the original source data, which means we're going into their QuickBooks and accounting system. We're looking at bank statements. We're examining invoices, receipts, and we're not taking anyone's word for it. We're, verifying from the, actual source data to rebuild everything from the ground up. So a QOE goes, far beyond what you'll see in tax returns, which, as I'm sure you all know, are often prepared to minimize tax liability rather than show the true performance of the business. And it's much more comprehensive than just looking at a standard P&L, which also might not account for owner adjustments, one-time events, or other factors that contribute to the actual earning of the business. And finally, a good QOE does not just tell you what happened. It also identifies financial risks and operational dependencies that could affect your future success as the new owner. Now you might be thinking, this sounds expensive and time consuming. Do I really need this? And to that, I want to share some sobering statistics with you. In our experience, financial misstatements of 10 to 40% are common in business acquisitions, especially in these, smaller, $1 to $5 to $10 million businesses. And that's not necessarily because anyone is trying to deceive you, although sometimes that is the case. It's really because small business financials are often incomplete, inconsistent, or prepared for purposes other than selling the business. And this is why a QOE matters so much. So first, financials are often inaccurate or incomplete. Small business owners typically focus on running their business, not maintaining perfect books. Second, QOE protects you from overpaying. If the EBITDA is overstated by even 10%, you could be overpaying by hundreds of thousands of dollars in your acquisition. Third, we identify red flags and working capital gaps that could create cash flow problems after you take over. And finally, if you're pursuing SBA financing, or depending on who your lenders are, there are lenders that now require QOE as a part of their approval process, which to me makes a ton of sense. If you're a lender, I would also require a QOE. So the bottom line is this: you're about to make a huge financial investment and decision, potentially the biggest of your life. The cost of a quality of earnings report is minimal compared to the risk of buying blind. We've seen too many buyers discover problems after closing that could have been identified beforehand with proper due diligence. And that's exactly why this is so important. So let's talk about timing and when to engage Centurica or another quality of earning vendor. So the ideal time is as close to LOI signing as possible. In our best case scenario, we are talking to clients before the LOE is actually signed, and we're in communication with them. We understand the deal. We have a draft of our engagement letter ready, so that when the deal when the LOI is finalized, we can, jump in and get moving right away. As I think you are aware, once the LOI is signed, the clock starts ticking. And so the sooner that we can start after the LOI is official, the better. And just sharing that we also have like a pre-LOI, like red flag audit review that's a lighter scope that we also offer and work with some buyers. That is a lighter version, aimed to help identify major red flags before you submit the LOI, and can save you time before going into a full QOE. or yeah, just not wasting time and money on bad businesses. So really, the important thing is time is of the essence. Time is of the essence. Once an LOI is signed, the clock starts ticking, and so the sooner we can engage to the LOI, the better. Now, let me walk through what is included when you engage Centurica or another QOV firm for a report. So again, this is not just a financial review. It is a complete financial reconstruction and analysis. So first, we do a complete P&L rebuild and normalized EBITDA calculations. Again, we're not just adjusting the numbers the seller gives us. We are rebuilding the entire P&L from scratch using the source data. Next, we rebuild the balance sheet also from the ground up, which often can reveal liabilities or assets that were not properly recorded or disclosed. Third, we establish a working capital peg, and this is crucial because it determines how much cash the business needs to operate effectively, which directly affects your cash flow after closing. Next, we do a cash flow reconciliation to make sure that the reported earnings actually translate to cash generation. You'd be surprised how often businesses show profit on paper, but struggle to generate actual cash. And this is the difference between EBITDA and cash flow. Fifth, we validate the revenue quality and seller add-backs. And sellers often claim certain expenses as one-time or owner-specific that may not actually be actually be the case and shouldn't be eliminated. Then last but not least, we provide a comprehensive risk and red flag assessment that identifies potential operational and financial risks that could affect your success as the new owner. The result is a complete picture of the business's true financial health and earning potential, everything you need to make an informed acquisition decision. Now, let's dive deeper into one of the most crucial components of our analysis, and that is the P&L rebuild and EBITDA normalization. So we typically rebuild 2 to 3 years of profit and loss statements, and I'll say our standard is going to be 2 years plus whatever into the current year. So the last 2 full calendar years, and then and then current up to whatever wherever we are into the 3rd year. And so yeah, it's important to do a couple years. 1 year can be an anomaly. 2 years plus, you get to see patterns and trends and seasonality, really the true performance and trajectory of the business. But we are not just looking at historical performance. We're normalizing the EBITDA to show you what the business is likely to earn going forward under normal operating conditions. So what do we normalize for? First, owner compensation adjustments. Many small business owners either underpay or overpay themselves compared to what you'd need to replace them with a manager or operator. Second, we validate add-backs. Sellers love to claim that certain expenses are one-time or owner-specific, but we know what is market and verify whether or not those add-backs are actually legitimate. And third, we do remove actual one-time events, so things like legal fees for the sale itself, unusual equipment purchases. And finally, we account for seasonality patterns to give you a realistic picture of what to expect month by month. So really, the goal is to answer the question, if you own this business and operate it normally, what would your EBITDA be? So that's the number that you should be basing your purchase price on, not the potentially inflated number that the seller might be showing you. All right, next, let's talk about the balance sheet rebuild, which is often where we find some surprises. And potentially not good surprises. So our approach to rebuilding the balance sheet, similar to the P&L, is go from all the source data. Why? Because prepared statements can, hide a ton of things. And so when we go directly to the source, the actual, accounting software, the bank statements, invoices, we often find discrepancies that weren't apparent in the cleaned up versions that were shared by the sellers. So what are we specifically looking for? First, accounts receivables and payable. Are they real? Are they collectible? And are they properly aged? Second, prepaids and accruals. Are there expenses that have been paid but not yet incurred, or expenses that have been incurred, not yet paid? Third, and this is a big one, could be undisclosed liabilities. We've found things from underreported credit card debt to pending legal issues that weren't disclosed in the initial financials. And finally, we look at inventory and asset classifications to make sure everything is properly categorized and valued. So here is why this matters. Hidden liabilities can significantly impact the deal value. If we find $50,000 in undisclosed debt or realize that there's, aged receivables that need to be a write-off, that's $50,000 less that the business is worth. And that affects your working capital, well, the business valuation, the working capital calculations. And these aren't like theoretical things. These are fairly common that we see when going through QOB and rebuilding the balance sheet. All right, working capital analysis is one of those things that sounds boring, but is super important and can really, make or break your acquisition. And I will explain why this is so critical. So the first thing we do is we define the working capital peg. So this is like the baseline level of working capital that the business needs to operate effectively. So you can think of it as the minimum amount of cash tied up in receivables, inventory, or other current assets, minus the current liabilities that the business needs to function properly. Why does this matter? Because it prevents post-close cash shortfalls. And this is something that unfortunately we see too often, where a buyer closes on the business and within the first few months, they are scrambling for cash because the working capital was insufficient to maintain operations. Maybe the seller collected a bunch of receivables right before closing, or they delayed paying some bills. Either way, you're left holding the bag. So this is especially important for SBA finance deals because some SBA lenders require, part of the SBA process requires working capital analysis as a part of their approval, because they want to make sure that the business will generate enough cash flow to service the debt, and inadequate working capital is a red flag. So the bottom line is proper working capital analysis protects your investments and ensures smooth operations from day one. It's not just about the purchase price, it's about making sure you have the cash flow you need to succeed as the new owner. One of the most important things that we do is align reported EBITDA with actual cash generation. You'd be amazed how often these two numbers don't match up, and understanding why is critical for your success running your future business. So EBITDA is an accounting concept. It's earnings before interest, taxes, depreciation, and amortization. And while that number is important, cash flow is what actually hits your bank account. And EBITDA often does not equal cash. There can be significant timing differences between when revenue is recognized and when cash is collected, or between when expenses are recorded and when they're actually paid. We analyze several key areas here. First, collections, patterns, and timing. How long does it typically take for the business to collect its receivables? Are there seasonal patterns? Are there any customers who are consistently slow to pay? Second, we look at cash burn rate. How much cash does the business consume in its normal operations? Third, we analyze capital expenditure requirements. What does the business need to spend on equipment, technology, or other assets to maintain its competitive position? And finally, we determine the business's debt to service coverage ability. This last point is super critical if you're using debt financing. The business needs enough cash to not just pay you a return on your investment, but also to service whatever debt you take on when you're buying it. So again, we've seen deals where the EBITDA looks really great on paper, but when you factor in the actual cash generation patterns and debt service requirements, the numbers don't work or get quite sticky. So let's talk about two critical areas that can make or break your deal: revenue quality and add back validation. On the revenue side, we're not just looking at the total number, we're analyzing the quality and sustainability of that revenue. So we examine revenue quality by looking at recurring revenue versus one-time revenue. Is this business built on repeat customers and predictable revenue streams, or is it dependent on consistently finding new customers? We analyze customer concentration. For example, if 40% of the revenue comes from one customer, that's a very different risk profile than if the top customer represents 5% of revenue. We also look at channel concentration risks. Is the business overly dependent on one marketing channel, one salesperson, one distribution method, etc.? So the key question that we're answering here is this revenue sustainable? Because sustainable revenue equals sustainable value. On the add back side, sellers love to inflate EBITDA by claiming certain expenses as add backs. Expenses that supposedly won't continue under new ownership. And it's our job to validate those claims. So we examine each claimed add back to determine if it's actually legitimate. Often we discover additional valid add backs that the seller missed, expenses that truly are owner specific or one-time in nature, but more often we find that many of the claimed add backs actually aren't add backs. And yeah, that's a big, we look at a ton of deals and go through a ton of deals, and so we actually know what is valid and market versus the seller that is trying to claim as many add backs as possible to have the highest EBITDA, to get the highest valuation. So the critical warning here is that invalid add backs can inflate the purchase price significantly. If a seller claims $100,000 in add backs that aren't actually add backs, and you're buying at a 4x multiple, you could be overpaying by $400K. So that's why thorough revenue and add back analysis is so essential to protect against overpaying and being in a really tough spot post-close. Oh, all right, so a good quality of earnings report doesn't just tell you what happened in the past. It also looks at and identifies risks that could affect your future success running the business. We categorize these into two main areas: operational risks and financial risks. On the operational side, we look for owner dependency issues. How much of the business's success is tied to the current owner's personal relationships, expertise, or daily involvement? We examine key vendor reliance. Is the business overly dependent on one or two suppliers who could potentially disrupt operations? And we analyze team gaps and dependencies. Are there key employees whose departure could significantly impact the business? These operational risks affect day-to-day business continuity. If the business can't function without the current owner, or if it's vulnerable to the loss of a key vendor or employee, that's something you need to know before you buy. On the financial side, we look for revenue recognition issues. Is revenue being recorded properly and consistently? We search for undisclosed debt obligations that might not have been revealed in initial discussions. And we analyze declining performance trends that might indicate underlying problems with the business model. Financial risks directly impact deal value and ROI on your investment. a business with declining performance or hidden liabilities is worth less than the financials might initially suggest. And so the goal with this risk and red flag identification is not to kill deals. It's to make sure that you go into the acquisition with your eyes open and are informed, both understanding the opportunities as well as risks you're taking on. And just, I'll say that again, because it's super important. Like all businesses and all investments have risk. What's important is that you are aware of these risks, and these are risks that you are comfortable with. Yeah, every deal has risks. No business is perfect, but you don't want to get blindsided by something, and that's what we are trying to prevent against. Let me walk you through our process so you know exactly what to expect when you engage with Centurica or a quality of earnings firm. So we have a 5-step process. First is first we'll say is the signed, executed engagement letter, which then will go into the kickoff and data request. We'll have initial meetings with you as well as the seller to understand your specific concerns and objectives. And then we'll provide you with comprehensive data request list that includes everything from QuickBooks files, bank statements, customer contracts, etc. Next, we go into the seller interviews or just seller calls. We have in-depth discussions with the seller to understand the business model, key relationships, operational processes, and any unique factors that might not be apparent from the financial data alone. Next, we have the analyst deep dive. So this is where we really dive in the majority of our work. Where we're rebuilding the financials, analyzing trends, validating assumptions, and identifying risks. Step 4 is the draft review. So, we'll walk you through the initial findings, answer your questions, and make sure you understand the implications of what we've discovered. And last but not least is the delivery of the final QOE report. This includes all of our analysis, findings, and recommendations. In a format that you can use for decision-making and, if needed, discussions with lenders or other stakeholders. Our standard timeline is 2 to 4 weeks, more like 3 to 4 weeks, but we have done deals closer to 2. And this gives us time for thorough review, validating while still fitting within, standard diligence windows. The timeline can vary greatly depending on the complexity of the business as well as how well organized the seller is with their data. That's the biggest impact on the timeline is going to be, how quickly we are able to receive the data that we are requesting and needing. And one other thing just to add on the process, we do our best and really pride ourselves on good communication throughout the process. And so, if we find anything significant at any point in the process, you will know, we'll be in contact. It's not just like a black box of like, okay, boom, 2 weeks later, here's the report. We're sending updates and communicating what we're doing, what our progress is, where we're getting stuck, where are bottlenecks in terms of, data that's missing. As well as if we happen to encounter any red flags earlier in the process, we let you know. So pricing. So what does QOE cost? So we have, we can call it the Hayden Special, which was requested specifically by Hayden with some extras included in the scope. So yeah, you can see on you can see, in the Hayden Special or Acquira Special, the quality of earnings, proof of cash, detailed income statement and balance sheet analysis, revenue analysis, COGS and expense analysis, headcount analysis, accounts receivables deep dive, accounts payables deep dive, net working capital analysis, all for one easy price of $15K. And again, this was something that, I mean, Centurica has worked with Acquira. Yeah, we've done a bunch of projects together over the years with both Acquira students as well as like Acquira's team's own acquisitions. And so whenever we're doing Acquira projects, it's always the tailored scope that Hayden requested. So real quick, a little bit about what makes Centurica unique. So one is we are 100% M&A focused. We're not we're not CPAs. We don't do tax. We do M&A, which means all of our experience and expertise is all around deals, supporting our clients, giving you information to make the right decisions and get deals done. We have a ton of industry experience, worked with, since my ownership, probably at least 300 or more deals, tons of different industries, tons of different business models. So we have, just a ton of relevant experience. We are, certain SBA are approved by some SBA lenders. And our team is led by ex-Big Four leadership, which means you're in good hands. All right, some final takeaways. Appreciate everyone's attention and listening. So really, don't fly blind into your 6 or 7 or multi-7-figure deal. You wouldn't buy a house without an inspection, and you shouldn't buy a business without proper financial due diligence either. The stakes are too high and the potential consequences too severe. So next, you can think of QOE as insurance, leverage, and peace of mind all rolled into one. It's insurance because it protects you from costly mistakes. It's leverage because it gives you negotiating power if issues are found. And it's peace of mind because it allows you to move forward with confidence, knowing that you're understanding what you are buying. Third, and this is super, super crucial, every issue that's not caught pre-close becomes your issue post-close. Once you own the business, you own it, all of its problems, disclosed and undisclosed, known and unknown. Your debt payments are starting, whether or not you have identified all of the risks and liabilities. So the time to find and address these issues are before you finalize the documents and wire the money, not after. Bottom line is smart buyers invest in due diligence. The cost of a quality earnings report is minimal compared to the risks of buying blind. We've seen too many buyers learn this lesson the hard way. Don't be one of them. So that is it. Thank you for your time and attention. I hope this was useful. I'll be sending Andy the slides so can be distributed. There's my contact info if you want to email me, Nate at Centurica. Check out our website or just book a call direct with our team, calendly.com/Centurica. So now happy to open up for questions. What questions do you have? What can I help clarify? All right.
This is Brian. Nate, hello.
Hi, Brian.
The cash flow versus the EBITDA. What are the patterns that you see where those two things are far apart?
I mean, one example that's like super far apart would be any business that's heavy on buying inventory. So, product businesses that you need to buy inventory, inventory is like a balance sheet. So and also I'll first clarify that like I am not an accountant. I own this company and run this company. But yeah, some of the like niche things might be, I mean, I can, pass off to my team, but yeah, so like physical product businesses, you need to, buy inventory beforehand before it's sold, which affects cash flow, but not EBITDA. And so, I mean, I actually years ago had my own physical product business, and like, the P&L would show, oh, we made, X profit every month, whatever, looks all nice, but like cash flow is a total mess because like, great, you're selling a lot of stuff, but then you need to buy more. And like every time you're buying more inventory, and like that doesn't show up in EBITDA. So yeah, I mean, anything with like significant, inventory is going to be a huge gap.
Hmm. Got it.
Who else? Don't be shy.
I don't know the question, Nate, but I just want to say, I mean, thanks. I just signed my engagement letter with you guys today.
Oh,
So
cool.
we officially kicked off our diligence here today. So looking forward to it. And I can
Great.
say that I spoke to a few other diligence firms as well that we were referred to, and you guys, your scope seemed the best tailored to what exactly we were looking for, as well as honestly fee. I know it's a eye popping number to some, but I can vouch that it was better than some of the other ones we got. So
appreciate you saying that. We're definitely going to do our best to kill it for you. And yeah, I mean, just to kind of add on what you say, like, I know some stuff that differentiates us is like, we're very, client driven, and like, happy to like, depending on your needs, if there's certain questions or this, like, we really want to do our best to be accommodating. Whereas a lot of other vendors, as you said, in my understanding, are pretty, rigid about what you get. And also, yeah, from a price point, I know, especially compared to some, like our fees are like very reasonable. And so appreciate you saying that, and look forward to supporting you on the deal.
appreciate it.
I have a question.
Yep.
You had mentioned that on some deals you are SBA approved, which I assume means that the SBA would cover your fee cost. Is that correct?
Well, so SBA, so lenders generally are agreeable to including diligence fees into the loan package. And so yeah, and this is like, I'd say most lenders, so like even when you pay our fee, and like the way that our fees usually work is like 50-50, down payment at the engagement, and then 50% at the conclusion of the engagement. But those fees basically can get paid back, um, out of pocket, and included in the loan package. So yeah, if that clarifies.
Yes, that does clarify. Thank you.
What else?
Nate, you mentioned that there's a 15,000 Hayden Special. Do you have QOE studies that fall outside that?
You mean like a different scope aside from what is included in the Hayden
I mean,
Special?
are most of what you do for Acquira the 15K specials?
Yep. Yeah.
Okay.
And that's like our standard QOV scope, like plus some extras. I mean, I know Acquira is, mostly like home service companies, but like we also have and sometimes do like software deals, and we have some like tech analysts that we can include to do some, tech DD, which would, be different from the scope, but not particularly relevant if you're buying an HVAC company. But yeah, we also have like a little, and I think it's actually still included with the Hayden Special, but like a little bit of kind of like online analysis, or just like a little bit of internet marketing kind of website check things, which like are more important for online based businesses where most of the it's more digital than in person. But yeah, there is some kind of additional stuff that we look at.
Okay, thank you.
Hey, Nate, this is Larry.
Hey, Larry.
Hey, wondering if you could say, I heard you say something about a pre-LOI service. Can you say a little bit more, provide some more details about that? I was just curious.
Sure. Yeah. Well, we offer, there's a few things that we do. We have like quick deal reviews where, I have to see what it is. It's like not expensive. Maybe it's like a couple $100 or $500, where it's like, we just have one of our analysts like goes through all of the material that's available, looks at the sim, looks at the financials, does their own analysis, and then hops on a call to like review everything with you or with the buyer. We had some other, I'd have to see, so we have that, and then there is also another kind of like a pre-DD that we do, that's like a little bit more heavy on the financial analysis, more than just kind of like a review of the sim and this. I have to like, I know we do those, like they're not super frequent, so I'd have to like confirm the scope, but yeah, those are things that we can do. And yeah, kind of like what Carl mentioned, we really want to be helpful and supportive, and so like yeah, happy to share things that we can do pre-LOI, and if there's other things that like you think would be useful to and supportive, we can definitely explore it.
Okay. For the pre-LOI services, do you know offhand if those are also permitted to be rolled into the SBA loan?
Yeah, I think you can, like any of your any just like deal expenses in general are generally able to be rolled into loan. So legal fees, financial fees, or diligence fees. Yeah,
Okay.
lenders are usually like, I haven't really heard of many issues with any of those fees being included.
Okay, thanks.
Hey, Nate, thanks for the overview, and apologies for any background noise on my side. I was just wondering, for the team that's conducting the analysis, are those some kind of equivalent certification of like a CVA, a certified valuation analyst, or something like that?
No. So our team is, it's like financial analyst is really the background. A lot of them, have like transaction experience. And so I think what you're asking, like the CVA or some sort of certifications around valuations, that's stuff that we like, in some of the pre-DD or the pre-LOI stuff that we do, like, we can give a like ballpark, comment regarding the valuation, but like we aren't like official valuators. We see a lot of deals. We have a good idea of like what's market, but yeah, our team, it's like, the core of it is financial analysis, and like, M&A transaction work is like the background that we, hire. And yeah, the like official valuators or valuations is usually that's not our scope.
Gotcha. Okay, thanks, Nate. That makes sense. Appreciate it.
Yep, no problem.
All right. Well, if you don't have any more question, I'd like to again thank you, Nate, for sharing your insights. I mean, this session is really helpful for everyone. I'll share this deck and his contact numbers to everyone. Well, before we wrap up, do you have any questions before we let Nate go? Okay, I guess none. So we have a couple of minutes left. I'll give it back to you. Enjoy the rest of your day, guys.
All right. Yeah. Thanks, everyone. Any questions that come up now in the future, you have my info. Feel free to reach out. We love working with Acquira. You know, you're very informed. You know, it's a great program. And so, yeah, the buyers coming from Acquira, you know, have a good level of knowledge and sophistication, which certainly helps and helps us, you know, when we're doing our work. So yeah, happy to explore any ways we can help. Yeah, I'll share the slides and any questions now and in the future. Don't hesitate to reach out. Happy to help.
Thank you,
again,
Nate.
Nate.
Thanks.
All right. Thank you.
Bye, guys.
Bye-bye.
Bye.